Oh shit, my brothers, you need to wake up right now because a massive financial storm is heading straight toward our portfolios. Look, I am sitting here right now enjoying the beautiful view in the south of France, but I am honestly pissed off. I am mad because Bank of America just released a private institutional report that sent massive shockwaves across Wall Street. They titled this report "The Door to Doom Has Opened," and let me tell you, this is absolutely not clickbait or random speculation. This is a direct, urgent warning from one of the largest financial institutions on the planet, stating that a critical economic threshold has officially been crossed. It is the exact same financial anomaly that preceded every single major market collapse in modern economic history. The terrifying part is that 99% of retail investors are completely blind to what just happened behind closed doors. Wall Street is definitely not sending this high-level data to your inbox. They only share it with their billion-dollar hedge fund clients. But we are changing the entire game in this video because every single market crash creates a brutal transfer of wealth. It is the ultimate arena where prepared individuals can turn $10,000 into $100,000 in less than a year. The only real question you need to ask yourself is whether you will be ready to strike or if you will panic and lose everything like everybody else. My name is Felix Breen, and I have spent the last decade deeply studying market crashes, not to scare myself, but to profit immensely from the chaos. I truly believe you deserve access to this life-changing research just as much as some wealthy suit managing an institutional fund. If you agree with me that everyday investors deserve the truth, just type the word deserve in the comments right now. I did not just bring you the raw facts from the Bank of America report, I also built a complete beginner-friendly explainer guide. Those Wall Street analysts love to write in confusing jargon, so I completely translated it into plain English so you can take action fast. You can download that blueprint completely free over at felixbreen.org/doom with no credit card required or weird strings attached. The link is right there in the description and pinned in the top comment, so go grab it, but let us dive into what is actually happening. The very first massive alarm bell that Bank of America highlighted is something they call the Maginot Line of the global bond market. Now, if you remember your history classes, the Maginot Line was a massive, supposedly impenetrable defensive wall built before World War II. In the modern financial system, that defensive wall was the 30-year United States Treasury yield, and it just slammed past 5%. Let us break this down simply because bond markets sound incredibly boring and confusing to most normal people. When you lend your hard-earned money to the United States government for 30 years, they pay you a fixed interest rate called a yield for decades. That critical rate has safely stayed way below the 5% mark, acting as a dam holding back financial chaos. But when that yield aggressively breaks above 5%, it means the biggest investors on earth are demanding massive premiums. They are forcing the government to pay more because they sense extreme structural danger. Meaning the smart money is getting incredibly nervous. Bank of America deeply analyzed every massive economic bubble in history, including the 1989 Japan collapse, the 2000 dot-com crash, and 2008. The pattern they uncovered is completely identical every single time because when long-term government borrowing costs go to the moon, the boom times end, the defensive dam is officially cracked, and according to the top strategist at Bank of America, there is no silver lining inside this document. That is just the first alarm bell. And it is honestly the most complex macro concept we will cover today. So take a deep breath. The rest of the data is much easier to digest, but I really wanted to shake you awake with the heavy stuff first so you know this is real. Alarm bell number 2 is what Wall Street calls the historic 4% inflation rule, which is based on an entire century of market data when the core inflation rate sustainably climbs above 4%. A very specific mathematical domino effect triggers across the stock market. Historically, stocks drop an average of 4% over the next 3 months, and then they slide down an additional 7% over the following 7 months. Right now, consumer prices are aggressively rising at nearly 4%, but the real nightmare is buried in the producer price index. Manufacturing and wholesale production costs are skyrocketing at a massive 6% right now, which is a massive red flag. When those massive manufacturing costs inevitably trickle down to the retail shelves, your purchasing power gets completely wiped out. You will have less money to buy basic things. Retail spending will freeze and corporate earnings will take a massive hit. To fight this monster, the Federal Reserve is forced to keep interest rates high, making corporate and consumer borrowing incredibly expensive. Those high borrowing costs crush stock valuations, while energy costs, electricity bills, transportation, and rent prices go up across the board. Bank of America explicitly projects that we are heading straight into a sustained 5% inflation environment, which is pure history repeating itself. Now, I promised you a massive silver lining that Bank of America refused to put in their report, and I will give it to you if you stick around. But first, we have to look at their third terrifying alarm bell, which they visually call the alligator jaws of Wall Street. Picture a massive alligator opening its mouth wide, where the top jaw represents the stock market melting up to new record highs. The bottom jaw represents the bond market collapsing down as yields spike. And right now, that gap is the widest it has ever been in human history. The fundamental law of capital markets dictates that these alligator jaws must always close. And there are only two ways it can happen. Scenario A is that the stock market violently crashes downward to meet the reality of the bond market, which is incredibly painful for retail investors. Scenario B is that bonds miraculously rally upward to meet stocks, which requires high inflation to completely vanish overnight, given the current geopolitical chaos. Scenario B is almost impossible, meaning Scenario A is the highly probable outcome waiting to hit us. When those jaws snap shut, the correction happens fast and wipes out anyone who is unprepared. So just let that sink in for a minute. Pause this video if you need to, and drop a comment below telling me if you honestly believe we are living inside a massive bubble right now. By just understanding these three institutional warnings, you already know more about macroeconomics than 99% of people on the street. I know it feels completely overwhelming and dark, but this is exactly where the story shifts and gets incredibly exciting for us. I have spent months meticulously analyzing what happens to individual assets during and after these massive, terrifying market liquidations. The data reveals a beautiful truth that big financial media corporations never advertise to the public. Market crashes create self-made millionaires. Let's look at the actual historical numbers from the 2020 pandemic crash when the entire world was locking down and unemployment was spiking. If you had the courage to invest $10,000 into a beaten-down company like Freeport-McMoRan, you would have walked away with $98,000 just 24 months later. That is nearly a massive 10 times return on your capital in 2 years. While everyone else was panicking and crying if you bought Royal Caribbean Cruises at the absolute bottom, you would be up a massive 9 times your money. Zoom Video gave investors a 7 times return, and Block did the exact same thing by multiplying investor capital by 7. The average winning stock coming out of that massive crisis rallied by 500% in less than 24 months. If you look back at the brutal 2008 global financial crisis, you see the exact same wealth building patterns play out all over again. Royal Caribbean went on a massive 9 times run in less than 2 years. While Bank of America stock printed a 6 times return from its lows, Freeport made the list again by printing a 7 times return, and Caterpillar multiplied investor capital by 5. The smart investors do not panic when there is blood in the streets. They systematically buy quality assets at massive discounts, but you absolutely cannot just throw random darts at a board. You need a strict rulebook and a tested wealth-building framework. A massive 30% correction is mathematically inevitable at some point, and most people will lose their minds and sell at the absolute bottom, but the elite investors who know exactly what they are doing will be quietly positioning themselves for 5 times and 10 times returns. That is exactly why I am hosting a live, comprehensive training event this weekend called the 10 Times Crash Returns Blueprint Workshop. I am going to completely break down the exact mathematical framework for identifying these massive crash winners before they start their historic runs. We will analyze which specific economic sectors produce the biggest gains, the exact technical indicators for buying and selling, and how to avoid traps. The class is completely free. It will run for about 2 hours, and you can secure your entry ticket right now over at 10xreturns.org. The secure link is right down below in the description, and since it takes massive energy to run these, I will likely never host this specific one again. So bring a notebook, bring a pen, tell your close friends, and make sure you show up completely on time because there will be no replays. This is easily the biggest wealth building opportunity we will see in the next decade, so do not sleep on it, but let us look deeper into what Bank of America is saying about the mechanics of the current market bubble. When the stock market artificially pumps higher, people look at their screens, see their portfolios up, and instantly feel incredibly wealthy. They start spending money aggressively because of this paper wealth effect, which causes corporate revenues to look incredibly strong. That corporate strength drives stock prices even higher, creating a massive self-reinforcing happy loop that feels like it will last forever. United States household equity wealth has skyrocketed by a massive $4 trillion just this year alone. Following $10 trillion last year, that sounds absolutely amazing on paper. But you need to realize that this is not real, tangible wealth. It is completely paper wealth. It only exists as long as the music keeps playing, and the exact second the cycle reverses, that wealth evaporates into thin air. Bank of America explicitly notes that this massive boom loop will eventually be terminated by 2 specific forces: politics and bonds. Right now, both of those forces are flashing bright red warning signals, especially inside the massive semiconductor and artificial intelligence sectors. If you look at the long-term 200-day moving average for tech stocks, the current price is sitting a massive 60% above that line to the average person with a normal social life. That metric sounds like completely meaningless financial math, but the 200-day moving average represents the true emotional baseline and normal price of an asset over the past year. When an index stretches 60% above its baseline, It acts exactly like a tight rubber band stretched to its absolute breaking point. Eventually, that tension snaps back violently, and it completely breaks the fingers of retail traders who are holding on at the absolute top Bank of America. Compared this current AI chart to only two other extreme periods in financial history, which should terrify you. The first was the legendary Mississippi bubble in France during the 1700s, which caused one of the worst financial collapses in human history. The second was the 2000 dot-com bubble, which completely wiped out trillions of dollars of retail capital across the globe. I actually started my personal investing journey back in 1999, and let me tell you, it was a brutal time to learn the ropes. I instantly lost 50% of my entire net worth because I had absolutely no idea what I was doing, and I completely missed the recovery. We are sitting in incredibly dangerous territory because stock market concentration is at a 50-year high right now. The top 10 largest stocks in the S&P 500 have driven a staggering 72% of the entire market rally this year. The other 490 stocks in the index have basically done absolutely nothing, while big tech carries the entire weight of the financial system. That makes this entire market rally incredibly fragile because it relies completely on a handful of semiconductor and chip companies. If the artificial intelligence narrative slows down for even a single quarter, the entire system faces a massive, rapid systemic collapse. Bank of America brought up a historic case study that most people will absolutely hate to hear, but we have to look at the cold data. In 1989, Japan was home to the single largest asset and real estate bubble the world had ever seen. When that massive bubble finally popped, the Japanese stock market plummeted by a staggering 80% from its peak. It did not recover in a couple of months. It took over 30 long years for investors to just break even, completely ruining generations of retirements. The macro warning signs recorded right before that historic Japanese collapse matched the exact data Bank of America is tracking today in the United States. History does not always repeat itself perfectly, but it definitely rhymes. And this specific rhyme is loud enough that you need to take it seriously. But look, I promised you that I would not just leave you filled with doom and gloom, so let us talk about my personal 4-step recovery framework. This is the exact system I use to build my personal watch list so I know exactly what to buy. The second a market panic hits, you definitely want to write these 4 steps down in your notes right now so you are ready when the matrix glitches. Step number 1 is deep value recovery, which means focusing on the most brutally beaten down sectors of the economy when mass panic hits the street. Institutional margin calls trigger automated liquidation algorithms that sell off absolutely everything. They throw the high-quality babies out with the dirty bathwater, forcing world-class companies to trade at bankrupt price points. The second the initial fear subsides, the mathematical snapback in these specific stocks is incredibly violent and highly profitable. That is exactly how Freeport stock went from $5 to $52, and how Royal Caribbean printed a 13 times return. We specifically search for high-quality businesses that have dropped 70% or more from their previous all-time highs. Inside our private analysis app, we use a custom quality scoring algorithm that filters out the noise and ranks businesses from 0 to 100. We can easily filter for top-tier companies across North America that are being unfairly punished by short-term market conditions. For example, Freeport currently holds a very solid quality score of 68.